Okay, thank you everybody for coming this evening. We appreciate you being here, and special thanks to our distinguished experts for this evening. They'll be sharing with us their outlook for upcoming oil prices for next year and the factors that will affect these prices. So special thanks to them. We've had some recent events that have been pretty striking, I think, about the changes in the market. We saw OPEC decide to agree that there'll be some production cuts, and maybe the production cuts will be as much as 700,000 barrels. And we saw today, again, the price of oil go up over $50 a barrel for West Texas Intermediate. So these are things that can dramatically affect and improve the oil and gas market for us. And so we should get things rolling. So let's do that. Let's start with introductions of the distinguished experts. We're going to proceed through the evening simply in alphabetical order. So we'll start with Carl Larry. Carl is the Director of Oil and Gas at Frost and Sullivan. And then we'll go to Raoul LeBlanc. Raoul LeBlanc is a Vice President and Managing Director for the IHS Financials team here in Houston. And then we have Afo Ogunike. He's a Senior Analyst at Wood Mackenzie here in Houston as well. And then down from Denver, we have Tony Starkey. Tony Starkey manages the crude oil team at Platts Analytics Ventec Energy. So So the way that we've kind of formatted the meeting, and I'll try to keep us pace if we can. Of course, it's all about presenting the information and answering the questions that you have. So that's the first priority. But I will try to keep us running on schedule as much as possible. So we'll start with each of the experts presenting a brief summary, roughly 10 minutes on their outlook for next year. And so after that, then we'll go into kind of a moderated question and answer session. I passed out some slips. You'll see some slips on your table. And the point of that is to for you, as a question comes to you, please write your question down and pass it up towards the front. And when we're done with the summaries, so we'll request that you hold your questions on these pieces of paper, pass them up, and then after the summaries are done, then we'll go through the questions. We'll have a few announcements, and then we'll after the announcements, then we'll have some networking time. And of course, the experts will be here. I think everybody's allocated time to be here to talk some more with you individually. So with that, let's get started. Carl, you're first on the order. Carl Larry, Frost and Sullivan.
Let me ask everybody, I need to take another look at this. Okay. Before I get this presentation, I just want to tell everybody that being an analyst, and I'm not an expert, it's an analyst, what I try to do is that I try to get it, well, I don't try and get it really, really right. That's impossible. I just try not to get it really, really wrong. Well, I mean, if you understand it, it's a lot like marriage. But what I really think is important is that this year, next year, nobody really knows. And just the other day, they called me up. They said after the OPEC thing, do you want to change your outlook? Do you want to change numbers? I said no, because you know what? It doesn't matter. I mean, again, I want to separate me from everybody else here. I'm a little bit different. I'm not an expert. I'm an entertainer. That's what I do. I talk. I make up numbers. I say really cool things. I get on TV, and then I just worry about it tomorrow. It's not about that. I mean, if you want an expert, that's the guy who says, oh, oil's going to be $20, and it's not. And then you know what happens? Like 3 months ago, they want to know what he thinks now. Why do I care? I mean, he got it wrong, so very wrong. He was close, but close doesn't count, right? You know, it doesn't have to make sense in this market, it just has to make money. And so that's what I say when I try and give you all these ideas and things about it. I want to tell you where I went wrong. I don't want to tell you where I'm going to go right, because I don't know what right is. At the end of the day, come November, everybody's talking about the OPEC. What's up in the name of OPEC? It doesn't matter what happens to OPEC. Start with the FOMC meeting on the 1st and 2nd. If the Fed raises rates and rates go up and the dollar goes up, then what happens? Oil prices are becoming very defensive then. So whatever OPEC does has to go back on the dollar. Okay, let's skip that. Forget about FOMC. Then what happens next? Presidential election. Now, before we get all huffy and puffy here, let's all remember what just happened this year. Brexit. I talked to a hedge fund manager at the beginning of the week before they had the Brexit vote. I said, what do you think? He said, you Americans are crazy. I go, what? I go, you guys gonna vote this Brexit thing? He's like, no way, it'll never happen. Multi-billion-dollar hedge fund, no idea. Brexit comes, goes, boom, they're out. Then just a week ago, maybe you follow or not, Colombia thought they had a very big peace deal with FARC. Fell apart last second. Everybody voted against it, didn't want to give concessions. All of these elections, everybody thought they knew it was gonna happen, and we didn't. So when it comes down to the presidential election, we don't. And I'll give you my theory here, right now, before we talk about the 17 forecast. I do believe if Trump wins, we're going to see tariffs on Middle Eastern oil. Just my thought, just an idea, but I do think it'll happen. Then, after all that gets said and done, we do have an OPEC meeting. And that's all going to depend on whatever happens to the dollar, whatever happens to the U.S. election, and whatever they want to do then. That's in November. We're not even close to 2017 yet. So the world could change, everything can change, and again, whoever's in presidential office could make all that the biggest difference. So quickly, we'll go back to 2016 review. One of the big things, yeah.
Can you move over just a little so we can see your screen?
Oh, absolutely.
Can this maybe move over? It might help.
Maybe,
us.
how's that?
Have this over here a little bit. There you go.
You're standing perfect. There.
So basically, I'll just give you a review if you can't see it. The one thing about 2016 you have to remember, it's not about crude oil. It never was. It still is. It's about demand. Gasoline demand was the highest on record, and it's still high. And you want to know why? It's because of unemployment. Everybody says, well, you know, unemployment's no good. It's only part-time jobs. But when you're in gasoline demand, it doesn't matter. If you're working part-time or full-time, nobody cares. You have to drive to work. Outside of New York and Chicago, those are the only two metro systems in the country that really matter. Everybody else is driving to and from work. Jet fuel demand was off the charts. We haven't seen jet fuel demand like this in over 10 years. Distillate demand was a little bit off, but exports were lower. Now you take all of those products that we're talking about demand. Refineries were running at a record high. They're still running at a record high. We've just dropped nearly 1 million barrels a day in the last 5 weeks, and we're still above 16 million barrels a day. In 2007, we were running refineries at about 15.5 million barrels a day. We didn't even get towards 16. So the real story of last year is about demand. We had plenty of crude. That doesn't matter. People like you and I were consumers of products. What matters is demand. Now going forward, we're going to look at the same things, except the refineries are going to hit something called capacity constraint. There's only so much they can do. There's a lot of refinery expansion this past year. We're not going to see any more next year, maybe a little bit, but going forward from here, it's going to hit a wall. So if demand keeps growing with GDP at only maybe 1.5%, it's really going to make a big difference going forward. Imports, I think, have hit a ceiling this past year on 8 million. They're going to stay there. OPEC, I'm going to throw that one out the window. That doesn't matter. And consumer demand. I think, again, it makes a big difference going forward. Now, when it comes to prices here, again, it used to be, we used to have a price. We aimed for that price. Now it's a range. You know, if somebody tells you they can tell you where the price is going to be, we don't. You know, I could play 3 cards on here, shuffle them down, and you have a better chance picking the right one than I can tell you about oil prices next year. So my range is 44 to 54. I think that Brent's going to be 46 to 58. I think distillate's going to be $1.92, and gasoline we're going to look up to 255. Now you look at all these numbers. I'll tell you what makes a difference here is that we have supply that's limited right now in the U.S. production. We could see that increase if there's going to be more demand. We still have a lot of spare capacity going outside the world. But what's going to happen is, again, something I mentioned before, and I do mention it here in the bottom point there under WTI. we have that capacity constraint in our refinery system. If we ran at 100%, that's almost 18 million barrels, so that's maybe an extra 1.5 million right now from where we're at. That's it. That's all we can do. So no matter how much crude there is or how expensive it is, we can't take any more crude. That's all there is. Now Brent's going to have the same issues. You're going to have refining margins still tight in Europe. Obviously their demand's going to be still slacking. China's the same way, and there's not really a lot of storage, not just in Europe, but also around the world. Diesel supply, I think it's going to be tight still. We're going to still see that there's room to move, especially if countries like Venezuela struggle. It's not so much their crude I'm worried about, it's the refinery production. Gasoline just keeps going up. If we keep adding more jobs, more people are going to drive. So that's kind of where I'm looking at here. Very big, very vague, but again, it's roll the dice this year. There's too many factors that we're looking at going forward that we're not going to be able to predict. Again, you know, come November, where nobody knows. We don't like to think we know, but like I said, with the past two votes that we saw on the Brexit in Colombia, it's a toss-up. And for me, that's about it. Thank you very much for your time. If there's any questions later, please, I'll be happy to answer them.
All right, thank you. Can you hear me if I don't? Okay, good. It's better for me. Okay, so I'm going to tell a little story here about what we think has happened. A lot of this has been very interesting for us to take a look at. So just to show you a couple things, big picture stuff. We don't think that OPEC is a meaningful category anymore. Instead, we're dividing the world into 3 parts. And you can see them here in this graph. So what do we call the Gulf 6? This is important. This, you know, the big countries of the Gulf. And what's interesting is this gray line. And you can see here a surge in production, first from Saudi Arabia and Iraq, and then again, okay, more recently this year from Iran and Saudi Arabia, right? So they're up 3 million barrels a day. At the same time, prices are falling like this, right? And demand has been very good in those last couple of years, but not that good. Then you've got the US, Canada, Russia, sort of the big producers of the world, okay? And what they're doing here is they were coming along, they've been relatively steady. Canada had problems last year, but it's temporary. We actually think they're going to start growing again. I'm going to hit that theme here in a while. The big difference that we think in 2017 versus 2016 is the rest of the world. And the rest of the world was doing a really good job of falling during 2016. This is a big deal. We had a lot of cleanup of the market. We went from roughly 1 million barrels a day oversupplied to relatively balanced. Unfortunately, it was a good year, but it wasn't good enough because we didn't get rid of the massive, overhang of stocks. Okay, so 2016 was a great year to rebalance, but we're not there yet, and that's why prices are sort of meandering in this realm. Unfortunately, this is a big deal. Next year, the rest of the world actually is going to do okay. Like, how can you possibly be doing okay? And the reason is that it's a confluence of projects that are coming on stream. All of these things were sanctioned at $100, mostly paid for at $100. They just happen to be showing up in 2017. Okay? And it makes a difference. So the relief that we got this year from the rest of the world finally suffering and falling production looks like it's going to come off next year. So you put it in a balance, and that's all this is. These are my inventories. You can see we're roughly 2 million barrels a day every day coming out of the ground that weren't getting consumed. So your stocks were rising. Now we're frankly, kind of back to balance. Okay, and there's some stuff going on with product versus crude inventories, blah blah blah. But big line is, we think we're roughly balanced. Unfortunately, we still can't get rid of the surplus. Now this is a net picture that puts all of our demand stuff together and all of our supply stuff together. So you can talk about any part of it. You can pick fights with any part of it you want. That's just where we are in terms of the net number. Right? On the demand side, this is the number you want to key on here, 1.4 million barrels a day. You're like, wow, that's an awesome number. Unfortunately, it's not really an awesome number because only about 800,000 or 900,000 barrels a day of that is actually demand for refined products. The rest is these NGLs, the petrochem startups in the Middle East and somewhat in the US. And then also because of the product inventories that are so high, right, the diesel and gasoline, your demand for incremental crude, we think, is only going to be around 600,000 or 700,000 barrels a day growth. Okay, so unfortunately, we're not getting great demand growth. China is relatively weak. India was star performer last year. This is an interesting way. You tell that rest of the world outside of a couple of places, if you put the growth areas, Russia, Brazil, Canada, Europe, surprising, and Kazakhstan, and into one bucket. Okay, what you see is, in 2016, nothing came on stream. These are new projects on stream, okay? 2017, we have a record in that set of countries. Now, outside of that set of countries, in the whole rest of the world outside the US and Gulf 6, everything continues to fall. So the price is still having an impact, okay? It's just that we have this set of countries that are growing from a project standpoint. Of course, you also have vulnerability in terms of geopolitics. This is political robustness, and this is economic robustness, okay? Is something going to blow up? Nobody can tell, right? You just don't know. But you have countries under pretty severe stress. The big three that everybody asks us about all the time, yeah, are, no surprise, the ones that are the weakest, okay? And that's a deal where it's a black swan event. It could blow up, okay? You can't bet on it, but on the other hand, you know, your likelihood is moderately higher every year that you have these creaking countries doing that. So that's, we don't build in any kind of, you know, blow up, but it can happen. Now, let me focus on the US, because I think it's a really interesting story. This is our US forecast. We actually have it bottoming out kind of this month or next, okay? And starting to rise. We think entry to exit next year, it's up something like 300,000 or 400,000 barrels a day. So this is a really interesting phenomenon. What we're seeing is the US has readjusted, reset it. It's incredibly painful, okay? But it's going to return to its growth mode, okay? And that's a little bit scary for a lot of people in the rest of the world, but we think the US can do it. And here's why. Take a look at this. This is a line from a new metric that we created. We call it the production efficiency of capital. By the way, we're not estimating this, we're measuring it well by well. Thanks to this young woman right here, by the way. Anyway, it's production efficiency of capital. What you can think of it is as the near-term production brought on stream per $1 million. Okay? So you can see it was around, hanging out around 50, going up, and it was going up literally about 1% a quarter for years. Okay? As prices started to fall, it has jumped to 10% a quarter. It's gone up 1,000%, the rate of improvement, okay, in that. And you now are getting per $1 million about 102 now. So your every dollar spent gets you twice as much oil as it did just 2 years ago. Okay? The red bubbles are the average break-even prices, okay, for the system. And you can see, remember about a couple of years ago when the price started to fall and everybody said, okay, this is an $80 world, yeah? You can't survive less than $80. Well, that was a bad notion for a minute. I'll talk about it in a second. But it really was an $80 average world. It's now down to about 53. I think it's actually probably less than that. That's a first quarter 16 number. So the massive improvement in capital efficiency is what has driven the U.S. to be in a place now to resume growth. There's also the fact that you have a tailwind from declines. The U.S. decline next year, the base decline, right? I don't drill any wells with it. Should be about 570,000 barrels a day less than the base decline in 2015. Okay? Because, you know, you stop drilling wells, you get more wells on the flatter part of their decline, and the whole system gets easier. So restarting growth becomes easier after a cessation of growth, right? So, 2 more slides really to talk about. So this one is a little bit of, okay, how did that curve happen, right? Why did productivity take off? And we think the headline number is really driven by 3 things, all of which you know, but which we're trying to measure, right? Cost, okay? Mix shift, and well design, okay? And you're not going to be happy here in a minute when I go to the next slide, but this is just the difference between a 2014 well and a 2016 first quarter well, right? I'm using 68% more profit for horizontal wells, right? They're 24% longer, right? I've got all sorts of mix shift going on and wells, which ought by all rights to be 10% more expensive because they're more complex, are now 24% less expensive. So I got a massive decrease there. Now, so this is kind of interesting. So if I take the headline capital efficiency number that I showed you from that first page, right, going from low 50s up to 102, that's the headline number. It's up 94%. Everybody feels good about that. Everybody says, oh, this rejuvenated sector. But if I start to look at what has contributed to that, it, in my mind, becomes a little bit less impressive. If I first normalize it for service sector costs, and this is not learning how to do things better. This is strictly the gift from out of the service sector pocket into the E&P pocket, okay, from something that costs the same. That is about 60%, okay, of the gain. Right? Once you normalize for that, you're down to 34%. The next three are mix shift, okay? We are shifting away from verticals, okay? The number of horizontals is higher. The next one is the shift between plays. We stopped drilling the Mississippian and we kept drilling the Eagle Ford, okay? And then the third one is the migration within plays. If you can see it, take a look at the Bakken. If you look at the Bakken next time, and you look at a well productivity map, and where the recent spuds are, it is just basically 100%. Everybody's offsetting their very best acres. They're totally cored up, and that means that the average looks better, okay? And it is better. Then we got lat length extension. We got proppant intensity. And this is actually 0, I put 1 to be generous, okay? What this means is that if you drill the same well in the same zip code and you had the same cost, your results today are really not any better than they were in 2016. Which is surprising to a lot of people. Now, we can measure all of these things except we can't measure this, which is real, okay? We're estimating at 10 to 15% gains that reduce cost due to productivity. I used one less casing string, right? I shaved 2 days off my drill time, right? I went from, resin coated to sand. Those are real. They compound all of these, so they're actually better in reality, okay? But point is, we actually have it, in a lot of ways, figured out the plays more. There's an exception to that, obviously, in the Permian, okay, where you have optimization going on. But in general, we have it. Nevertheless, all these are very impressive, and given that base, we think that the U.S. can put it together, put the money together, we think the break-even sort of maintenance price necessary is in the low 40s, okay? So if you give people 48, 49, 50, we think they'll put the money to work and they will grow it, because that is what they really want to do, and they'll get back to it. That's it for me.
Can you hear me? Good evening. Fantastic. Great. Well, my name is Afo. I'm a senior analyst with McKinsey. And for those who don't know, Wood Mackenzie is a leading provider of commercial intelligence to the energy, metals, and mining industries. And for me, I'm in the refining oil markets team. So our approach, is to do fundamental research. We have 200 upstream analysts around the world who are modeling fields and companies on an asset-by-asset basis. We also have a global team of demand analysts who are looking at economics, looking at refineries, looking at product markets. I put those two things together to develop our view for the price outlook going forward. Okay? So today I'm gonna, well, first of all, disclaimer, right? Done. Okay. I'm going to talk about how we got to where we are today, and then spend some time on demand, and then leave us with a look forward to U.S. oil markets. So how did we get here to begin with? First of all, so this chart here looks fairly complex, really simple. It's just showing the year-over-year change in global oil supply and global oil demand. So let's walk through it. Now the light blue line here is for 2014. You can see here that the change in global oil supply was outstripping the change in global oil demand. The same thing holds for the dark blue line, 2015. But in 2016, something happened, right? And you can see clearly that this total growth was much more than demand growth. And we had an oil price collapse. Oil price collapses, lots of companies struggle, bankruptcies occur, supply starts receding. And in 2016, we have global oil supply more or less being flat. At the same time, we have global oil demand increasing. For 2017, we're expecting more of the same. So we expect global oil supply to be relatively flat, but global oil demand continues to rise. And this informs our price view. And so, essentially, for next year, we're forecasting Brent to average about $54 per barrel on an annual average basis. Now, as you can see from the chart here, it's not the smooth sailing. So we expect Brent to be relatively in this range. That is like the high 40s to the low 50s from now pretty much through to like June next year. But as we expect the global oil supply and demand balance to tighten in Q3 and Q4 of next year, we expect some uplift towards the tail end of next year. And there's some, risk associated with that. But that's our forecast. So we're expecting Brent to exit 2017 around $62 per barrel. So I guess we're the most bullish people here today. But annual average basis for next year is 54. So let's delve in more into global oil demand. I think demand is really interesting. It's been relatively stable during this sea of uncertainty on the supply. I mean, again, thinking back on global oil supply, how it's really collapsed, demand has really been sustained. So the key thing from here is China. China is the blue parts of all these bars, and it's been relatively stable, and I'll delve more into China in a bit. But we're really seeing, some support in 2016 and from the US. But next year, we're expecting the rest of the world to actually pick up some more demand growth. Now, the rest of the world, that really includes the other parts of Asia, not included, in India and China, and also Latin America some. So China is actually quite interesting. We've seen some evolution in the nature of Chinese oil demand. So, let's thinking back in China, right? There were concerns about industrial growth and manufacturing. Today, I was reading an article talking about a certain shoe factory, which makes shoes from a lot of designers, including a famous someone's daughter who's running for president. And this shoe factory is actually moving some of its operations from China to Africa because cheaper labor. And that's raising concerns about demand. People see those sorts of stories and wonder, what's happening with Chinese demand? Well, I'm here to tell you, relax. There's still some going on. We're seeing transition from Chinese demand from being very industrial-led towards being more consumer-led. So by industrial-led, that's what I'm talking about a bit here. Back in 2011, a lot of this demand growth was diesel. So you're driving the lorries, delivering the raw materials to the factories, driving the lorries, taking the shoes that we made to the ports. That sort of stuff is diesel demand. But what's been happening increasingly is, as Chinese consumers become wealthier, they want things and they want mobility. And that translates to demand for things. Well, that's LPG demand, and that's this plastics really, light blue. And then they want mobility, so that's jet fuel demand, gasoline demand in China. So that's really what's supporting demand growth in China going forward. For 2017, we're expecting about a third of the growth to come from China. So it's very important still, and it's a key area of focus for us. So bringing it back closer to the US, we've seen a lot of change here in this country. I mean, from 2011 to 2015, we saw US oil supply grow by 4 million barrels a day. That's like adding 2 Venezuelas in 4 years. It's a tremendous amount of growth in a short amount of time, and that really helped precipitate the oil price collapse. So this year, we're actually seeing US oil supply decline, down by 600,000 barrels a day. At the same time, we're seeing US refinery capacity increase by 200,000 barrels a day. So put those two things together, and that alone suggests an increase in oil imports. And through the form, we've actually seen that happen. There have been some weeks this year in which oil imports were up 1 million barrels per day over the same week last year. And that's a good thing, right? Because the global oil market is oversupplied, so refineries importing more is good. They're churning away at that surplus we have in the market. Now this relationship though has implications for Brent and WTI. So looking forward, there are some concerns around WTI. We've focused so much on Brent so far today. This chart here indicates our longer term view. So the dark blue line is our outlook for US oil supply. We agree that that's going to recover and grow and surpass existing levels and reach new highs. Now the shaded light blue area indicates our view of how much of that oil produced in the US is processed in US refineries. Then the delta is the implied oil exports. And here's the key takeaway. Producers will need to send their oil to more distant refinery markets in the future. And that could have implications for WTI. We might then see a gap, a discount emerge again between Brent and WTI to facilitate those shipments. Because now we have exports allowed since December last year. So if you need to send more of your oil all the way to Europe, maybe to Asia, you're incurring higher transport costs. So you think through the transportation cost, WTI price and pushing, come down to the Gulf Coast, if it's full tire, $4, get on a ship to Asia, depending what's happening in the freight market, that's quite expensive. So that could have implications for Brent WTI longer term. So that's all I have for you today. Look forward to your questions.
Good evening, everyone. Is my voice okay? Can you hear me? So, I've heard people up here talking about whether fundamentals matter or not, whether speculation matters or not. I think all those things matter. All those things influence participants in the market. At the end of the day, what's going to move the market is money, right? And so, we all in the room have an opinion on the market. Unless you're somebody who has access to a screen who can buy and sell futures, it really doesn't have an impact on prices. So, before I joined Platts, I traded oil for 4 years at Merrill Lynch. So I'm going to kind of present the oil market, kind of both the bottom-up and top-down approach. So in terms of fundamentals, here's a chart of Brent over time. And this model price is literally just taking supply, demand, inventory numbers, and trying to correlate it to prices in the past. You can see it's not perfect, but you get general direction, to some extent magnitude. And if you look at the difference cumulatively between the actual price and that model price over time, you see that you kind of have these waves, these cycles, right? So you go through periods of where the asset is undervalued. You go through periods where the asset is overvalued. I think it's very similar to any asset that's out there, really. You go through these cycles, the prices are too low for a while, then prices are too high for a while. Eventually things revert back to that mean. And when I talk about money flow, the best way to observe that really is through the CFTC's commemorative trade report every week. They divvy up the market participants into 4 categories. So you have managed money, which is like your hedge funds. You have other reportables, which are other people kind of speculating on the market. A lot of algorithmic trading shops fall in that bucket. You have your producer merchant group, which this graph is showing, and that's kind of your large integrated shops, your large physical traders who have literally physical exposure to the market and using the derivatives market to hedge against that. And then you have the swap dealers, which is basically banks, which is the world I came from. But physical hedging matters because these guys are arbing barrels around the world. They're arbing storage. They're doing whatever it is the market's giving to them. And so when they are net long physically, physical barrels, they're going to be net short the derivatives market to offset that to the extent possible to protect themselves. So you can see here, this is showing their net length. So you're taking that whole group of folks, and you're taking their net long positions minus their net short positions. You can see that this moved up towards the beginning of 2014. This is implying the market was getting tighter and tighter. This suggests the prices should have been probably in that $100 range. But ever since mid-2014, you can see their exposures come way down. So they've been accumulating more and more physical barrels in excess of what the market needs. They're having to offset that by shorting the derivatives market. And if you plot that same kind of model thing against this, you can see it correlates quite well. One thing to note is I am showing WTI positioning here. I didn't have time to pull Brent, and the model is trying to forecast Brent prices. That disconnect in 2011, 2012 is when the Brent TI spread really blew out. So the Brent market was more tight than the WTI market. The WTI market was disconnected due to logistics, not because of global slack. And then talking about speculative money, so I'm really just talking about managed money here. So you're taking your hedge funds, you take their net position, you take all their net longs minus their net shorts, compare it to this producer merchant group. And I like to call this the paper physical trade. It's really the paper guys who have no real skin in the game when it comes to physical barrels, but they're betting on which way the market's going to go. And you're lining that up against the producers who actually are, the physical guys who have physical exposure to the market. And so the red line is showing the WTI price inverted. And the blue line is showing the difference between the managed money positioning and the physical guys positioning. So you can see when that blows out quickly, you do get a price move. So the red line moving down is price moving higher. You get a quick price move up, but then once the speculative guys realize that nothing's actually changed, physically they exit those positions, you get the corresponding drop in price, bring it back kind of to reality more or less. And you see these kind of cycles through time when this happens. And so, the question for us right now is that this spread has also gotten very wide again. It's moved very quickly. I imagine this is probably going to even more so because we don't have the latest numbers after the OPEC announcement. But I guarantee that speculative short guys got wiped out of the market. The guys are adding length to the market. But if there's actually no fundamental change to the market, I guarantee you that at some point that reality has to come back. Demand has not been an issue yet, right? This has been a supply-driven problem. That's why prices are slow. There's just so much supply. Demand has been very robust, as everyone's been talking about. Problem is, if you look over time, right, we go through this economic cycle as well. So if you look at GDP per capita growth year on year, correlate that to oil demand growth year on year, they correlate quite well. We're 7th year into this economic cycle. So the question is, how much longer can this thing go before we see a downturn? Despite all the central bank intervention, the markets, and everything else they're trying to do to prop up economic growth, we don't think they're going to be able to avoid potential slowdown that just naturally happen in the credit cycle. So in terms of what that model says now, if you just took what the EIA, IA, and OPEC were saying for supply and demand balance for 2017, and just plug those numbers in, it suggests the price would stay low for another year. If you take in a 700,000 barrels per day OPEC cut, and just plug that number in, it does suggest markets should get tighter at the back half of next year, and we'll see prices rise. Now our forecast is based on both the fundamentals, and we kind of take this top-down approach to the market. We look at positioning, consider sentiment in the market, and all those kind of things that will end up driving it. That cycle that you saw over time in terms of how actual price and model price deviate with one another. I'll have to do this from memory. There used to be dots on this graph. Okay. Well, I promise you that in December 14, whether you believe it or not, our 2017 price forecast was actually in the low 50s. This is despite the 2017 calendar strip at the time being above $65. You can see we've been very consistent over time. We kind of called this lower for longer theme at the very beginning. We didn't see any way it was going to resolve itself, especially after OPEC changed their posture towards the market. So you can see, I showed Jan 16 because that's when the prices hit their bottom. But we stayed kind of consistent, saying that was overdone. The prices would bounce back. Stay consistent with our 2017 forecast. And our most recent forecast is the first time we actually dropped below $50 for WTI over the past couple of years. And this is before, we put that forecast out before the OPEC announcement. And I think, along with what I'm here just saying, we're not generally probably going to change that very much, honestly, unless something obviously materially happens. If you go back to the previous slide, you can see we're kind of fundamentally, more or less, prices should be around 40. So even with an OPEC cut, sentiment in the market pushing things higher, we don't necessarily think prices are going to exceed $50 by all that much at the end. And I just include this picture because I think it's a very interesting picture to look at, considering the future of the oil market. That's my time today. Thank you.